is Barb Leibold, and I'm with Lorelei Marketing. Today I have three experts sitting here with me who are going to be teaching us about an exciting new product. These experts are actually from the financial education industry, and so I'd like to have them introduce themselves to us.
Great. Thanks, Barb. My name is Tim Butt with the Self-Empowered Investor.
I'm Ed Hawley. I'm with Hawley Investment Research.
My name is Mike Riker with the Emmaus Research Center.
Today our discussion forum will focus on the exciting product that I spoke of that addresses the painful realities that all investors have experienced over the past decade. Today you'll get to understand what this strategy is, how it works, and how it benefits investors. So let's get started. Would you describe this strategy, what this strategy is?
Absolutely. Thank you very much again. Before I start to describe this product, I just want to reflect on a couple of the key points that occurred over the past decade. First, we had two bubbles that popped, which cost trillions of dollars of losses for investors. Second, the amount of market volatility that we're experiencing today seems to be progressing more and more as we go through the markets. And third is the self-serving nature of the financial services industry and those that work in it that has evolved over this past decade. So over the past years, Ed, Mike, and I have had the opportunity to go out and talk and listen and understand what investors, what's important to them. You know, what are they trying to accomplish with their investments? And what we heard was, how do they protect the value of their investments during major market downturns? And number two, how do they ensure that their investment dollars are working for them and not someone else? Armed with that information, we set out to develop this new strategy. This strategy offers several key points. Number one, it provides stock-like returns with bond-like stability. Number two, it provides an academic, mechanical process that minimizes losses during major market downturns and also protracted bear markets. It's low cost, it's simple to implement and manage, it requires minimal trading and time, and it's all packaged in one product.
What type of investor, such as age and level of wealth, is this strategy designed for?
Well, one of the exciting things and fun things about this strategy is it really applies to anybody at any age. You do need to have a minimum of about $5,000 because of the asset class and diversification that we have, but it's fun, it's exciting. You can do it in a regular brokerage account, or you could do it in your IRA.
Interesting you target the do-it-yourself investor, and that is a growing trend among investors across all demographics. What makes this strategy unique?
Well, there's several things that make it unique. You know, one of the first that comes up is it's based on index funds and exchange-traded funds as opposed to mutual funds, which most investors are familiar with. I think a second thing is that it's a mechanical process that tells you when to get into the market, when to get out of the market. As Tim alluded to earlier, most investors are more concerned about what they lose or what they might lose than what they might gain. So it's a way of accomplishing that particular desire. The process is also based on academic research and a model using 5 asset classes to try to find out what kind of a strategy or what kind of a process will work through all different types of market conditions. And the last thing is that it's unique because it's really not offered by very many financial institutions, if any. I don't even know of one that actually offers that at this time. Okay. So, other than the three of us. So.
Thanks.
Mm-hmm.
Why can't I get this from the financial services industry?
That's a great question, Barb, and it's one that we always love to answer and respond to. All right? The simple answer is it's not the industry's game. And I'd like to just describe a little bit about what their game is. The industry focuses on selling and promoting products that serve their best interest and not an investor's. They also, in regards to leveraging the low-cost, passively managed ETFs and index fund that this strategy does, they make no money on those products.
Right.
And third, as you mentioned earlier, this strategy is specifically targeted to empower the do-it-yourself investor and to help them escape the tyranny of Wall Street and the financial services industry.
That's great. What are the challenges facing investors today?
Well, Ed mentioned as far as market volatility and how this strategy had mechanical type exit and entry points. The beautiful thing about this strategy is it addresses the two major concerns of investors today. First of all, investors are concerned about their emotions. Some of the toughest things investors have to do, they need to deal with as far as greed, trying to make a lot of money on the upside. They need to deal with fear, losing money on the downside, and then a lot of times not even knowing when to cut loose of an investment, and they sit on hope. So those three different emotions make it very challenging. The other challenge is just inflation. You know, we see now as far as with the prices of different things going up, you know, it's really important as far as the people have an investment strategy that's going to maintain their purchasing power. And this strategy does just that, Barb.
Okay, thank you. With those challenges and such a high degree of uncertainty, what options do investors have in such markets?
Well, other than find some method of protecting their investments, they only have a couple. You can go to cash, and I know a lot of folks that have done that. And the idea of going to cash, it's believed to be a very safe position to take. It's really not. In the end, you will definitely lose, guaranteed. At the end of the year, what started out at $100,000 last year will be worth like $97,000 in purchasing power at the end of the year. So that's not one that you really want to consider. You also have the idea that you can move to bonds, treasuries, and things like that.
Okay.
The returns on those, especially now, and there have been times when it was different than that, but for now, it's really not a good way to go because the returns are so low that they barely offset inflation, and then when you have any fees associated with it, you're going to break even or lose money. So it's not a way to go. The only real good way to go is to be invested in a market and get some kind of protection from the downsides that you're going to run into with the volatility of the market today.
Okay. Is there a downside to these options?
There's a few downsides to them. One, in regards to the all-cash position, and Ed extrapolated on this very well, you lose purchasing power. All right? When you're invested in an all-cash position or an ultra-conservative position, due to today's rates of return, you're not keeping up with the rate of inflation. So that's one big downside.
Okay.
The other downside happens to do with the fact that you're not in the market, you're not invested in stocks, so consequently, you're not going to be positioned to participate when that market comes back so quickly. And that again is another very important aspect. Is Ed touched on this earlier. You need to be invested in that market at all point in time. All right? So those are two key points. The other two are Mike said earlier, there's no clearly defined entry and exit points. So investors today don't have any methodology as to when to get out of the market, when the market's going down, and they don't have any re-entry strategy on when to get back in.
Right.
This strategy does exactly that. It provides you, based on that mechanical process, when to get out, when to get back in, and totally removes all emotions from the investment decision-making process.
Sounds really good. So how does this strategy address those challenges?
Well, that's a good question, Barb. It's like investors always have challenges dealing with their emotions. This particular strategy addresses those situations because it's mechanical. Rather than listening to the self-proclaimed guru, which a lot of people do, now you have a system or a strategy as far as where you can really let the voice of the market dictate as far as entry and exit point. So that's one thing I really like about this process. It eliminates the emotion. Automatically, by listening to the voice of the market, you're going to be in the market when it's trending up. You're going to be out of the market when it's on a perpetual downward slope.
So Ed, tell me how it works.
That's a good question. But actually, it works very well. And I think it kind of builds on the comments that Tim has made and also ones that Mike has made about being a mechanical system. You've got to get emotion out of this system if you really want to have true gains, because you're going to give up if you're trying to play the market and not understand what you're doing, which is what most people do. So this is it's a mechanical system actually based on an academic study done by universities, and what they've tried to do is go back and look at the last 100 years of the stock market and try to figure out what worked, what didn't work, when did it work, and when did it not work. And they've been able to develop a mechanical system based on a 10-month moving averages, and in their study they used 5 different asset classes. You could have more, you could have less, but that's what the study was done on, those 5 asset classes. And they represented these asset classes with exchange-traded funds, which are just low-cost vehicles, similar to mutual funds. They just cost about 1/10 of the cost of a mutual fund, or index funds. And those ETFs and index funds will represent various assets of world markets. So that's really what you're trying to do. Now, when you start talking about triggers and mechanical systems, you have a mechanical system that says you have to do something. Well, one of the things that's most important is to get out of the market when things are not doing well. So the first trigger point says you get out of the market when the price of your asset class that you're reviewing falls below the 10-month moving average. You get back into the market in that asset class when its price moves above that 10-month moving average. So you got a clearly defined way of getting into the market, getting out of the market, hopefully getting back in so you don't miss most of the recovery, getting out so you don't get back all your returns.
Okay. How much time does it require, Tim?
Well, based on the fact that we do 99% of the work,
Yeah.
not a whole lot. Right?
Cool.
15 minutes maybe max on a monthly basis.
Wow.
As I said before, we wanted to keep this product simple to implement and manage. We wanted it to require a minimal amount of trades and also time, and I think we've done that. The fact that we analyze all the 10-month simple moving averages, right? We assess if there's any triggers that need to be acted on at the end of every month, and we're the ones that send out the email. So again, based on the fact that we're doing all the work for the investor, all they have to do is open one email a month and perhaps a couple of trades a month, and that's it. 15 minutes. How simple can that be? 3 hours a year.
What benefits will the investors realize?
Well, one of the biggest challenges investors have is really being confused and frustrated and not really knowing as far as what kind of strategy they're actually implementing within their portfolio. This particular strategy offers peace of mind. Peace of mind that I'm following a mechanical system, that I don't have to necessarily rely on somebody's opinion deciding as far as if I'm in and out of the market. The other benefit of this is you have worldwide diversification implemented using low-fee ETFs. When you put that combination together, it's just a tremendous opportunity that can be fun and easy for investors to move forward without a lot of the stress that's typical with investors.
That summed up the value of this strategy very well, and it is certainly worthy of consideration by the do-it-yourself investor. I would like to thank each of you for coming today and sharing this truly unique investment strategy with the rest of us. More importantly, thank you for your efforts empowering the do-it-yourself investors to take control of their financial futures.